The economy is healthy, businesses are healthy, finances within many of the companies that are reporting look healthy. There's many good signs here. Let's find out what happened last week that would have caused so much of this concern or pullbacks within the market, certainly on Friday. Welcome to Life in the Markets. My name's Tim Russell, and today is June 8th, 2026. Over the last week, we've had the markets give back some of the gains that we've been able to achieve. Earlier this week, we did reach all-time highs in the S&P 500. We reached that, I believe, on Tuesday, but since then the market has drifted lower. And really, there was a bit of a rout on Friday as we had some good news sparking some concern about the Fed actions and so forth. We'll get into that just in a moment here. Just to cover the numbers so that we're aware of where we are, this week alone, we had the S&P 500 down 2.6%. Now, the equal weighted S&P, the one that isn't weighted based on how big a company is. Every single company gets the same amount in the weighting. That was only down 0.5%. It shows you that there's more of a pullback in some of the larger tech-oriented names. Overall, the S&P 500 actually had a fine week. I mean, 0.5% down in a week is really no big deal. The NASDAQ was down about 4%, again, showing us the tech-heavy emphasis here. Interestingly, the Russell was down about 3.11%. Again, smaller companies, they've gone up quite a bit over the last bit, and they've had some pullback as well. International markets down just under 2.5%. As we look at some of the other commodities, we saw gold was down nearly 5%, silver down nearly 10% on a week. That's a big move. Oil was up roughly 2.9%, and Bitcoin, if you follow the cryptocurrencies, again, incredibly volatile. Just buyer beware whenever you get involved with cryptocurrencies. They were down 18% over the last 5 trading days. Keep in mind now, as we move into the bond part of the discussion, bonds are also trending lower. We had a down week on the stock market. We also have a down week on the bond market. Bonds are down 0.8%. That's a fairly large move for bonds. If you notice, the ag bond market was down more than the equal weighted S&P. This is something that I, as a financial advisor, certainly paying very close attention to. The high yield bonds, as you would expect, down a little bit more, down around 1.06%. Treasury, as you would expect, was up. The Treasury yield increased 1.9 or 1.8%, bringing the yield to 4.544%. Anything above 4.5 is an area where I would really like it to kind of come down, get down to below 4.5%. I really think the Fed would prefer that too. Let's kind of dig into the numbers. Let's find out what happened last week that would have caused so much of this concern or pullbacks within the market, certainly on Friday. Look, we've had 2 really strong weeks in the S&P 500 and the overall markets. We've had a really good run. We had like 5 weeks and a bad week, 2 weeks and a bad week. It's not that concerning, frankly, that we've had some of these pullbacks. It's normal market activity. The decline was led with a drop in AI and tech-related names. We had some good news that came out specifically on Friday that caused a lot of this panic selling within the market on Friday. And panic is probably the wrong word, but certainly people were selling a lot of stocks much more deeply than we would normally see. So what was the good news? The good news came out on Friday, and that was regarding the unemployment data or the jobs data. As you probably know, on the first Friday of every single month, we get the jobs report. This is where we find out what the unemployment rate is, how payrolls are doing. There's a lot of very interesting data about the health of the employment economy, which has a significant impact on consumer sentiment and on consumer spending. So if we have a weak employment reality, we'll have weak spending, we'll have poor earnings, we'll have all kinds of struggles within the broader economy. Conversely, a strong employment picture is going to paint a more rosy picture about the economy, about consumer confidence, about consumer spending. We got some really amazing news. We found that rather than having modest job gains, we had 752,000 actually, this isn't job gains, this is new job openings. We have companies coming out and saying, we're looking to hire, we're open for business, we want to attract new talent to our employment. There were 753,000 new job openings. And what's amazing about that is the job openings, the lion's share of them, 668,000 of the 752,000 was in the professional services business sector of our economy. So much for this whole expectation of the AI apocalypse, destroying jobs and putting people out of work. That story is not done being written. There's still more, let's use a baseball analogy. We're in the fifth inning. We've got more innings to play. We don't know how it's all going to play out. However, I will say right now, it certainly looks like even with the amazing amount of AI spending, they're finding that there's more need for employees, to go and to serve within these companies to chase down the service opportunities, the business opportunities, the client needs, and the revenue that these employees can generate. This is a good sign for the overall economy. Furthermore, the jobs number came back and said, in terms of adding to payrolls, we had 172,000 people added to payrolls last month. This is a lot higher than what we estimated. In fact, it's almost twice as much as what was expected. 88,000 jobs was expected last month. We had 172. This is obviously pretty interesting, but it didn't stop there. They went back and revised the previous 2 months. So we got May's numbers, we got April and March were also revised higher. The combined total between those two revisions was another 93,000 jobs added to payrolls. This shows a remarkably strong employment picture. We've got a strong business environment. We've got a lot of people who are being put to work, and this obviously is good for the economy. We point all this out in spite of the fact that we have inflation and we've got worries about international conflict. We've got social unrest here at home. There are fears of consumers running out of money. There's all of these things, and yet the economy remains incredibly robust. In spite of what consumers are telling us about how they feel, the way that they actually act is really positive and encouraging. They're actually spending money and they're living their lives. They're concerned about lots of different things out there in the world, but with their own lives, with their own finances, they're feeling somewhat secure. So all of the fear-mongering out there about the economy being so bad it's not borne out by the facts. This is the strongest earnings season this last couple weeks, the strongest earnings season we've had in recent memory. We've had more surprises to the upside. We had more beat and raise on earnings than we've seen in a long time. Now, maybe that's just an indication that we're at the top. Again, I don't know. I'm not predicting the future. My point is the economy is healthy. Businesses are healthy. Finances within many of the companies that are reporting look healthy. There's many good signs here. All right, so Tim, you're telling me that the economy's strong, employment's great, consumers actually look okay. Why is that bad news? Good question. I'm so glad you asked that question. The answer is, well, it's bad in one sense. It indicates that the economy might be getting overheated, that maybe a bubble could be growing in assets, maybe people are getting too exuberant about the economy, and things could become overpriced. The fear is that not only, I think there are two sides of this fear. Number one, there's a fear that we're going to have greater inflation. When the economy gets too hot, prices increase faster than consumers can sustain, and that itself will cause a problem. In addition to that, the concern is that if you don't take a little air out of the balloon, it's inflating too fast, it could pop and cause more of a problem down the line. So the concern is that the Fed may see this and reduce the exposure to cheap credit that we currently have. They do this by raising the federal funds rate. It's one of the things that the federal funds rate will address. So I have a chart here, and this comes from the CME group. This is their probabilities chart. Now, first thing I want to note is that this chart shows the relative probability in given today's economic reality that by the end of the year, our interest rate for the federal funds rate are going to be anywhere between 3.25 to 4.5%. That's a very big spread. Now, right now, you'll see this big red arrow. The current yield, the current federal funds rate is 3.5 to 3.75. That's the current Fed funds rate. It is anticipated right now that it's about 70% probability that will be between 3.75 and 4 by the end of the year. And there's even a chance that we could go higher. Now, if you look a little lower on that chart, you can see the difference in how the probabilities have changed from a month ago to yesterday when I pulled this data. You'll see here that the current estimate was a 70% probability that we'd be exactly where we are now at the end of the year. That was a month ago. That's 70% probability a month ago. How much things have changed. We're at 27% today probability that we'll actually be at the exact same place we are. So a lot lower probability. That right there, the changing in the probabilities got traders very concerned, and they sold everything. They sold AI, they sold tech, they sold anything that grew, anything that was up. The reality here is the economy's strong, businesses are strong. The Fed will probably make some adjustments, but we're not talking about massive changes. We're not talking about the kind of level of 2022 where we had stocks down and bonds down. I don't know the future for sure, but we're not looking at that kind of a raise cycle. And if they do address it gently and lightly now, maybe what that will prevent is a larger and more draconian increase in the federal funds rate in the future. And let's face it, the Fed wants lower rates. They recognize that if we have higher interest rates, that affects Treasury rates, and Treasury rates is going to affect how much the Treasury spends in interest payments on their loans. So the government doesn't want to have higher interest rates. So I don't expect the rates to go very high. I do think they want to keep control of inflation. So why is good news bad news? Good news is bad news because the market anticipates the Federal Reserve may increase interest rates to prevent an even larger spike in inflation or potentially prevent an economic bubble. In the long run, I think this is what we really have to keep in mind. In the long run, it is a good thing that we have the Fed stepping in to do things. It's a good thing that we have a strong economy. The economy is strong. The companies are profitable. Consumers are showing resilience. Don't worry about the short-term market trends. Don't worry about the short-term market knee-jerk reactions. Focus on your long-term goals and on the benefits of investing for the long haul. This is where wisdom exists. That is where our clients want to go. That's where we walk with our clients through the good and the bad of the market. So if you want to have someone who can give you a Christian perspective to trust in the Lord and not in your wealth, if you want someone to be able to walk with you through the good and the bad of the markets, reach out to us at thelifegroup.org/contact. And we would be happy to meet with you and help you find how you can become an even better steward of all of your assets. Today's verse of the day comes from Matthew 6:31 through 33, and I love this passage. Therefore, do not be anxious, saying, what shall we eat, or what shall we drink, or what shall we wear? For the Gentiles seek after all of these things, and your heavenly Father knows that you need them all. But seek first the kingdom of God and his righteousness, and all these things will be added unto you. Thank you so much for listening to today's episode of Life in the Markets. Today is my 24th anniversary, so Christine, thank you for your faithfulness and bearing with me all of these years. I love you dearly, and thank you for all of the years that we've spent together. I'm looking forward to more. Until next time, take care, God bless, and you be safe out there in the markets.
The topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. All information herein is from sources believed reliable, but is not guaranteed for accuracy or completeness. The team assumes no liability for any errors, omissions, or actions taken based on this material. Information is as of the date stated and subject to change without notice. Securities and advisory services offered through Genius Wealth Management. Member FINRA and SIPC.